Welcome everybody. Thank you for joining us today. We are going to be discussing today how to mitigate risk with your watch list. Now, I know that sounds kind of new for a lot of people, but this is a way a lot of funds and a lot of big guys start reducing their mental exposure to the markets. And honestly, mental exposure is the biggest part of trading, period. Before we get started, I just want to make sure all of you know that we are starting classes next week on Monday. This will be the 4-day course, which we are going to go over options 101. So this will cover a little bit of your watch list, but mostly about just calls and puts in general. Also, pretty much making the transition from an equities trader to options trading. You guys will get full access to me, unlimited access to the classes, along with access to my chat room. And yeah, it's a pretty good deal, guys. Feel free to check out the link that Charlie has just shot in there. It is in the question box. For anybody who has any questions, feel free to just type it into the question box or into the chat box. Charlie, can you put that into the question box instead of the chat there, so they have it? And yeah, we'll just go ahead and get started here. So before we actually address a watch list per se, we sort of need to put this in context of what people are actually doing when they're trading, period. Most of the time, anybody who's looking at the markets is looking for a technical setup. All right, so essentially they are basing a lot of their watch list around technical setups. So every day they're going to flip through some charts, or possibly every night they're going to flip through some charts and find what's a pennant forming, a bearish, pattern, or a bullish pattern, an inverse head and shoulders, all this kind of stuff, and they're going to try to predict those moves as they come along. And that's a relatively good start for all of it. It's very, very tough for those of you who do not understand how stocks trade and who do not read tape. A lot of the pros out there that like to play what's hot, what's really moving, they're actually able to read on the fly how this stock actually trades. So essentially, they can make the best decision whether or not to buy a breakout, short a breakout, or buy a dip, or short the breakdown. And this is relatively important, guys, because stocks in general have a certain behavior to them. All right. For instance, Amazon out there, you can't really buy a breakout on Amazon. Okay, if you buy a breakout on Amazon and try to hold it for more than 5-10 minutes, this thing's going to come right back in your face. Same with a bunch of these other stocks like Facebook. Even if you do have like a solid looking pattern forming on it, it may just rip against you, with a matter of seconds. And maybe you're good at playing those, maybe you're not. But the whole idea here is to be able to really hone in on what you're good at. Okay, if you're good at breakout trading, maybe you should find the stocks that are relatively good at forming breakouts and can hold those levels. Can hold a breakout. And this comes down to the watch list. All right. So I know a lot of guys out there are probably looking at 500 stocks a day, narrowing it down to 100 stocks by the end of the week. And they're playing everything left and right. Maybe you're holding like 4 or 5, 6 positions in your portfolio that you have to manage, and you're looking at 10 different things on your screen. All right. This in general is a lot of wear and tear on your mental and emotional capacity to manage positions. All right. Not only that, you're also watching the SPYs. Maybe you're watching XLF. Maybe you're watching your Nasdaq if you're in a tech, and it can get kind of hairy. All right. And one position might go against you. The way you exit it may not be 100% the way that you would have loved to have gotten out. And what could have happened is that it might mess up the rest of your trades. And then all of a sudden it's a domino effect, self-fulfilling prophecy. You turn a positive day into a losing day, or you just completely wipe out your account. I've heard this happen so many times. And so that's why we bring you to the point of managing your watch list. All right, managing your watch list is a very, very simple, basic, but important way for you to reduce the mental strain. If you look on the shared screen here, we do have our watch list up here, and that watch list, it's relatively small, but we've actually even limited it down even more. Okay, so usually we'll scan across sectors and we'll say, all right, the markets are looking like this. We need to time it relatively well. with certain moves with the SPYs, or if we're playing a tech, it has to go well with the NASDAQ. And we're watching the big movers. We want to watch something that can have big moves, but also time it well with the markets, because those are going to be the best setups. Ideally, they're going to work 100%, but they don't. And the best way for us to understand when they don't work is because we know them intimately. All right, we've been looking at the same stocks for years and years and years. All right, so that's a clear example there of how you can, one, develop a relationship. It's kind of weird to think about it that way. Develop a relationship with the stock that you're trading and understand that, oh, maybe Amazon is never a breakout buyer, but it's always a dip buyer. Maybe that you should always look at your Facebook on a daily chart and never look at it intraday. Maybe you have to always swing Goldman Sachs instead of day trading it. This allows you to make better and more sound decisions on how you trade these stocks. Now, of course, a lot of traders out there have this whole mentality of, oh, I'm going to pull $300 out of the market every day, and therefore I'm going to make XYZ amount by the end of the week, and then I'll have a certain amount by the end of the month, and I'm going to meet my costs. That's an okay way of doing it. I would consider that a relatively intermediate way of managing trades. All right, of managing your positions and learning how to actually create watch lists and also become successful at trading. The real traders out there, the really big head traders out there for, say, prop firms or for banks even, they don't trade every day. All right, a lot of days they don't do anything at all. Okay, what will happen is that because their watch list is limited, because they have a small basket of stocks, not all the setups are going to occur. For the past 3, 4, 5, maybe 6 days even, the markets haven't been yielding the best returns on a lot of these stocks that we have on our watch list. And when that happens, you know what we do? We sit on our asses. We don't do anything. We literally just sit there and we don't do anything. And this is why it's really important for you to understand that maybe taking those days off because your stock isn't working is a way for you to actually understand better how you trade. Okay. And for those of you who like looking at all the watch lists and like looking through different stocks every day, you need to really understand how to read the tape. For instance, those of you that like to, this is a rite of passage usually for all traders in general. They love to play penny stocks. Okay, they love to play possibly biotech stocks and all this kind of crap. Penny stock. All right, we could just go, or a pump and dump. We'll just go through the basics of a pump and dump. Newsletters comes out. False news comes out on something, it gets pumped up, and then you're looking for the short trade, right? If you're looking for that short trade, what you probably have noticed is that it doesn't work the same way every freaking time. A pump could last an extra 3 or 4 days where you're going to get smoked on that short. All right, that's because it's a different freaking stock. There's a different float to it. There's a different number of shares that are outstanding. There's different players are in there. Different market makers are in there. It's part of a different sector, the whole nine. These are main things you have to understand about jumping from what's hot to what's not. All right, a lot of traders out there that are professionals that do trade what's hot and what's not, they only scalp because the mere fact that there's volume in it. All right, they'll scalp for 2 to 3 cents, taking large positions, and that's really tough because every day you're looking at something new. Every day you're looking at something that you don't exactly understand, and it's a big mental wear. Just to give you a little idea on how we set up our watch list, we again are trying to pick up, what's moving the markets. All right, just like you watch on CNBC, there's the big movers and shakers, or the leading stocks of the day and the laggard stocks of the day. We want to know this ahead of time because we want to be able to look at the SPYs. We want to be able to look at the NASDAQs and really say, all right, what's moving up right now? Are the SPYs moving? Is XLF moving? What's moving XLF? We have Goldman Sachs. We have JP Morgan. We have Citigroup, Bank of America, the big names in there that'll really, really push stocks and, push the indices. And we want to be able to look at those because usually those are the ones that'll yield the best gains, especially in options, all right? And for our sakes, we like to play, things that move. At least, I would say like 70 to 80% of the time, we like to play things that move relatively well and relatively fast. And that involves the financials and the tech sector. The tech sector, we have our Apples, we have our Googles. You can consider Amazon, possibly even Priceline can be thrown in there as well. That's more of a travel company, but they move together. All right, so we can actually even hedge a little bit of our risk when we're playing throughout the day. How we can look at Goldman Sachs if it's looking like a breakout and we're about to buy it. We're going to check out real quick, what is Citigroup doing, what is JP Morgan doing, what is XLF doing, all these things, and we'll be able to make a better and more sound decision on how to make that trade. And that's really important for how you guys manage your losers and your winners. And again, I'm sure you all know, if you're actually putting on positions, that this is all a mental game. For all of you that have been trading for at least 6 months or 7 months, you'll realize that if you're sitting in a loser or if you're sitting in a winner, you're going to be looking at the trade completely differently. And for you to not stare at something objectively is a huge detriment to your trading. All right, and managing your watch list is a very, very, very good way to actually do this. So I'm going to go ahead and actually look at Stan's watch list. So Stan sent an email asking, about, just overall, like what he plays versus, what he's actually staring at across the board. So right now he's got Apple, Google, Amazon, Goldman Sachs, Netflix. This is great. All right, these are the big names. I love these names. Apple and Google, great names to have on the board. Apple's, obviously we're looking for a bottom in Apple, all that kind of stuff, and she's a big mover. Probably like 3 months ago, Apple used to just purely be the stock that would move the entire markets. It's not so much anymore, but it is a big piece of the tech sector. If Apple moves up, you could get a lot of pull in the rest of your techs. I like that. Google as well, Amazon as well. Goldman Sachs, it's a great stock to have in there as well. I would probably include some other banks in there, and the bigger banks, just like we have the JP Morgans, the Citigroup, the Morgan Stanley, the Wells Fargo. You'd probably want to keep those in there as well to make sure that you're actually watching what the rest of the big banks are doing, because usually they'll trade together. Today's a little bit different because we have a post-stress test kind of environment right now, and it hasn't been exactly been playing out. But once equilibrium is established, because of ETF balancing and because of how funds balance themselves in single names, these will usually trade relatively together. All right. So here's the rest of his watch list, and this is where the rest of the real criticism comes through. We've got PEGA, Pega Systems. We've got Flowtech Industries, CVV, CVD Equipment Corporation. We've got Nike in here. We've got Silver Wheaton in here. That's an okay one to have. You have Facebook in here, Intel Corporation, Cisco. So what I'm already seeing is that this is much more geared towards the tech sector. All right, and that's good. But what happens? Actually, I'll say that's great. Okay, because if you're always staring at the tech sector, you're probably pretty freaking good at trading the tech sector. And that's a really good thing because you're not spreading yourself too wide. The only criticism I would have, this watch list is already probably 20 plus stock names. I think that's a little bit much. You're probably trying to pick, which one's moving on the day, and then looking at your NASDAQ or looking at whatever it is to see if you can get some pull. That's nice, but it might be sort of a pain in the butt to have to look back and forth to have to trade those stocks. And I would recommend probably shortening it a little bit and possibly sectoring it out a little more, get a little bit more financials in there, possibly some travel companies, maybe some credit cards, just so you know for your sake how the entire market is doing in general. Okay, Stan, I'm really glad that you're able to ask these questions. And that goes the same for everybody else. Think about your watch list. All right, look at what you're looking at today. All right, are you looking at the high-low ticker? Are you staring at the thing that your brokers want to throw in your face and say, hey, this is up 2%, you should trade it? Or are you actually, looking at certain sectors? Brokers are out there to take your money, guys. Don't listen to them, all right? They are out there to take your money, okay? If they're telling you play the high-low ticker, you're most likely going to get smoked, especially if you're going to be playing options, okay? If you have a watch list that's under 20 names, that's great. And for those of you who like to play technical setups, you might want to try to rethink a little bit on how you're setting these up. For instance, we have a member in our chat room you guys should check out, by the way, Denny Crane, who likes to play these what he calls tanker plays. All right, and tanker plays are relatively interesting because you get a huge tank, 2, 3, 4, 5, 6% tank, maybe on some earnings, and then you're looking for a small technical setup within there to really game the stock and to really get some movement out of it. This requires a lot of patience and a lot of, I guess you could say, tenacity to actually stay with this type of strategy. In general, it's simply because if you're looking for technical setups every day, they don't play out. If you look at, the Technical Studies Encyclopedia, the majority of breakouts only work, 30% of the time. Dip buys only work about 40% of the time. Inverse head and shoulders on top of this and on top of that only work so many times. And for technical setups, guys, you could look at so many time frames. I could look at, on a 1-year chart, then a 5-day chart, and then a 1-day chart. Look at it all the way down to the 1 minute and say, okay, this could be a long or it could be a short. Who knows? How are you actually segregating out your stocks so you can have the best returns, so you can have the best trades? Honestly, guys, again, manage those watch lists. Manage the way that you actually play these stocks. So that's pretty much our basic rundown of the watch list, guys. Feel free to ask any questions. We've got a few questions in here. Let's see. Can I ask you about writing naked options? So we could leave that possibly to a different webinar, but writing naked options is very dangerous, Randy. Be careful of doing that. Another question here, Matic is saying, to trade options with Google, Apple, JPM, etc., you need to have a big trading account. What about for the accounts which have around 5,000 USD? Matic, what you have to understand about actually trading these large names is that you can actually have a $5,000 account and trade them. All right, you don't have to always trade at the money. All right, you could trade out of the money. You could write with a $5,000 account as well. You can do a lot of things. You just have to be able to be selective. Again, I'd recommend checking out our 4-day course. It's a great way to stare at these things. It's a great way to actually play them. Out of the money options. Again, the whole reason why there are options is to how do they say, to shrink the amount of money you need to throw out for big positions. Instead of having to put $70,000 on the line to make $100, you can put $700 on the line and make $100. All right. Any other questions, guys? Questions. Well, what is it? I can't see it.
Why not have multiple watch lists for one intraday trading, another for swing trading, as value long-term stocks, so that's not trading. Have multiple watch lists.
Sure. So Suktej, being the freaking Suki that he is, likes to play a lot of trades that have intraday work, that have intraday breakouts, have intraday moves. And he's also asking, why not just have multiple watch lists? And that's great. That's a great idea. If you have say you're an investor, or say you're a long-term trader, okay, and that you like to swing trade, and you want to have part of your portfolio dedicated to that, and then you want to have part of your portfolio for actual day trades, and he's asking, why not have both and for watch lists? And that's a great idea. So that actually will minimize a lot of your worries on a lot of your trading. So you could have a swing trading watch list. Watch that on like a weekly basis. See if there's a big break on it. Buy some stock there instead of buying options, and hold those for a certain amount of time, and then segregate part of your account for day trading. Many of us do that. I think I'm not sure if Kathy's in here, but Kathy is she's a long-term trader. She's, I would say, a swing trader, investor, pulling out decent returns and wants to enhance those returns with options. That's a great idea. It's a very good idea to set any way that you can actually categorize and separate your stock names so you can better manage it in your head and make decisions on, oh, I should not do this, is a good thing to do with your account, guys. Let's see what other questions there are. So studying the charts for Watchlist. We are always, because we look at these things every day, we know the charts by heart. And that's another reason why it's much better to keep your watch list small. The fact that we only have like 8 to 10 stocks that we play now, we'll know like by the open, before it even opens, if Goldman Sachs is opening up at XYZ amount, that it's already going to look sort of like a breakout, etc., etc. And that's how it goes. But essentially, we do our nightly homework. It's always good to look at how your SPYs ended up, how your entire watch list ends up, and it helps you make a better decision on what to play tomorrow. For instance, after the huge moves in the past few weeks, it's been a chop fest for a lot of these stocks because we know all of them have made their moves already. And it's about time a lot of these things consolidate or possibly even came in short. And that's another great reason why it's good to keep your watch list small, because once you play it all out, they're all pertaining to certain sectors, they're all pertaining to the NASDAQ or the XLFs, you'll realize that, okay, maybe the juice is out now. Maybe I should wait a little bit and then come back in when the setups come back to you. The whole idea of trading, guys, is not to go after every opportunity, but to go after every opportunity that is worthwhile to you. Let those setups come to you. All right?
That's a good question from Stanley. Do you recommend adding ETFs to the watch list as a gauge of sector performance and keeping an eye on the top-down movements?
Sure. Stanley is asking about ETFs. So, yes, Stanley, it is a good idea to have ETFs on your watch. A lot of times, instead of having ETFs on the watch, those are the main charts that we actually look at. I look at the ES futures, I look at the SPYs, I look at the NASDAQs. Sometimes I look at the XLF, XLKs, but it's mostly about the big movers in those sectors. So if you have your NASDAQ up, you can sort of tell, what's pushing the NASDAQ. Is it Google today? Is it Apple today? You'll be able to tell immediately. And that's a very good piece to have there, because if your XLK is moving and it's about to break out, look under the hood. What's happening under the hood? Is your Google moving or is your Apple moving? Should you throw on a basket trade? It's probably the fact that you should be, paying attention to what's under the hood, moving those indices. But yes, ETFs are a good thing to have on board.
Nathan asked, do you guys only trade options on large cap stocks, or do you include some not as known companies once in a while? If so, when and why?
Nathan, we do not trade things that we don't know. Okay. Periodically we'll look at them, like the whole Ackman Icon nonsense. We stare at that whole, Herbalife nonsense. But, it's cool to watch, but honestly, what are you going to get from it? How much do you make from watching the biggest movers and shakers of the day? Can you really make big money on it? Can you really time a trade with the markets while this thing may be counter trend? That's very tough, because if you have a 2% bump in, say, Pandora today, all right? Pandora had a 2% bump in the morning. People might be saying, oh, it's 2% up. Maybe I should be buying this. It looks like a breakout. But while the markets are fading, this thing got tanked in the morning, okay? Even though it is up freaking, 20%, it dropped 2%, and you are about day trading. Where did you start your position and where did you end your position, all right? If you weren't in there before the 18% bump, you probably got smoked on your trade.
He's also asking about, the volume, like, do you trade less liquid stocks, only large cap, or, why would you guys only trade large cap? Volume. Why is volume important to us?
So, Suktej is asking a little bit about Baidu and Sina. And Baidu and Sina, yeah, we watch those. International firms, we do watch it, just because Baidu we used to actually have on our watch list. We just haven't played her that much. Overall, we like to keep our watch list to those names that are relatively liquid, that have high volume, because we need to be able to make those moves. And that sort of comes back to the question that Stanley was also asking, Nathan was also asking about what what volume of movers we like to watch. Guys, one thing to be very careful of, especially developing your watch list, is the float of your stock. Okay, that means that if you throw a 1,000 share position, are you going to move this market? Are you going to move all the sellers or the buyers in there? If you do, that's going to affect the way you trade. That's going to affect your pricing. It's going to affect your entries and exits. So you have to be careful of playing those stocks that are, like under $1, under $5, because if you throw too big of a position out, you might move it, and it'd be tough as hell for you to get out. All right, this is called liquidity risk. All right, you don't want to come into liquidity risk. That is one of the most dangerous things to come into, meaning that it's going to take you forever to get out of a position, and you're going to be selling lower and lower and lower and lower. And even though your initial exit was a positive exit, you end up selling all the way to the point where it's a negative return. All right, that's not good. All right, so we like to play things that have volume and have volatility in them, guys. Demetrius is asking if we'll ever have a training session, hands-on, 4-day course. Don't feel confident to go fully to the next step. Demetrius, I totally understand if the 4-day course did not get you 100% prepped for it. Take it again. Ask me more questions in there. I was in there. Why didn't you ask more questions? All right? Ask more questions. The whole idea with our classes, guys, is that you have full access to us. You guys even have my freaking phone number, okay? You can call me anytime you like and discuss what you're trading, all right? I give up a ton of information, all right? I've got fund managers and stuff telling me you give out way too much free crap, all right? You're spending too much time with these guys. I think that's BS, all right? We want to make sure that you guys are making the right decisions. Use us as a resource, okay? We are here for you. You have lifetime access to these classes, all right? We go over the topics. We go over market conditions, and these are really good things to make sure that you're taking in consideration here. All right, it's 1:30. Any other questions here, guys? Do you think calling me during a session would work? No. Yes, Cody, if you take the class once, you could take it as many times for free. Yep. No, Tom, we do not cost $2,000 per phone call, but I would be a freaking millionaire in a day if I had $2,000 per phone call. Jeez. Panda Bear is asking if we trade butterflies on weeklies. No, we do not, but we end up, because we leg into these, they sometimes turn into, what do they call, broken wing condors, broken wing butterflies, lopsided strangles, straddles, all that kind of stuff. They end up turning that way. We do play multi-leg positions, but we don't just call them. One of the big problems with options, guys, is that everybody complicates the hell out of them. All right, everybody makes it sound so ridiculous by saying, "Oh, this is a freaking butterfly strategy, the heart-healthy butterfly strategy, blah 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 blah." That's great and everything, but can you execute on it? Most likely not. Let's keep it simple. Let's keep it one leg at a time. All right. Let's see. Do you trade? Do you ever use buy stops in options? Buy stops are very dangerous in options because, again, these are things that we're going to teach in our classes. It's not just the movement of the underlying that determines how your options price. You know, your stop can be hit in a millisecond. Even though your actual underlying didn't move. So no, we do not use specific buy stops. There are specific ways that you can actually, go into spread trades to minimize your risk, or just in general, don't put so much money on the line. All right, that's another big lure about options. Again, we talked about this the last session, but you don't have to put that much money on the line. Your risk is defined. Okay. Again, that's more about the strategies. That's more about things that we teach in our courses. Any advice on 45.5, 46, 46.5 butterfly expiring today? I don't know what stock you're talking about. What do you think about Apple now? Can you make a trade from here? Apple, let's check this out. Let's make an assessment on Apple. No, there is no trade in Apple other than writing outside options, and we will not give you the bread and butter of that, but write the options on that. Do you use the stock price to exit an option position, or what do you use? Suktej, you're in my chat room. You know what I'm doing. Why? Yes, we use the underlying to determine what we're doing, but we don't only use it for our exits, all right? Because we play out of the money options, we have a better way of gauging blow-off tops, actually, and selling as we go, all right? So it's a little more complex. question than looking at just the underlying stock, but we do look at the underlying for our exits. What do you look for in the market to know when the choppy environment could be close to ending and back to a trend up or trend down? Boxton, great freaking question. So this again comes back to your watch list. You could look at the SPYs all day. We could be pumping up every freaking day like we have, but how are you supposed to tell risk reward it's not there for you? Freaking make a better watch list. Look at your watch list and look at how much higher are your banks pushing? How much higher are your techs pushing? Is what's under the hood really moving that well? If it's not, you could really reconsider, possibly not trading at all. Okay, not buying all the breakouts anymore, possibly switching to buying the dips, or if it's really time to start shorting the rips, all right, and then start shorting the breakdowns. This is a huge assessment that a lot of traders have problems with because they don't understand what's going on under the hood of a lot of these stocks, all right? When you see time and sales go off at 3 decimals, probably algos, so do you use avoid the trade when that happens because you know it's choppy? Tom. So in general, when we know it's choppy, we either do nothing or we're writing, okay? Now, staring at the tape directly and just saying that one trade is multi-decimal does not necessarily mean it's an algo. It just means it's a dark pool, and when that happens, it does not necessarily mean that it's chop. It just means that there are a lot of professionals playing in there, and that you should be careful of those levels. Anything else, guys? Anything else? Yep, for sure, Tom. No problem. Again, guys, we have to get back to some trading. I've got some phone calls to receive here, but again, feel free to shoot us an email, lucci@sanglucci.com. Make sure to check out our courses. Make sure to, make sure that you guys are on top of your game. The markets are only going to get tougher, okay? They're only going to get more compressed. Options, they're coming out with mini options in 2 weeks. All right, we're going to have a huge webinar on mini options. We want to make sure you guys are prepared for this stuff, okay? And again, feel free to check out our courses, sanglucci.marketfi.com. Come check out, what we're all about. Check out the link in the actual chat box, in the question box. These are all there for you. Feel free to ask us any questions. Charlie is going to be following up with a lot of you guys in here, and any questions that I have not answered will most likely get answered in a follow-up email, and this webinar will be recorded. So, yeah, that's pretty much it. Randy is asking, do we need to re-sign up for each class if you're offering and you've already paid? No, Randy, so you got to just make sure to shoot an email out to Charlie, and he will make sure that you have the links for the new courses, okay? All right, guys. We have a little bit more to do here on the day. It looks like we are pumping higher on the SPYs out of nowhere even after attempts at dumping. This is a really choppy market, guys. I hope you guys are not getting smoked and at least staying to scalping, writing, or doing nothing. All right? All right, guys. Thanks for coming along. Really appreciate you guys showing up, and happy trading. We'll see you soon.